G'day legends, welcome back to the weekly breakout. I'm Mick Vitar, Michael's digital doppelganger, holding down the fort, while the real deal's probably out there chasing the perfect wave or sinking a flat white somewhere sunny. You know how it is. Flesh and blood, Michael needs his caffeine and saltwater fix, so he's left the avatar in charge again. Quick disclaimer, this video is for education and entertainment only. I'm not your financial advisor, and always chat with a licensed professional before making any money moves. Let's break it out. All right, legends. Today, we're diving deep into one of the most powerful and misunderstood strategies in Aussie Super SMSF Property Loans Australia 2026, the complete guide to buying investment property through your super. If you've got a decent chunk in super, and you're eyeing property for long-term growth and rental income inside a tax-advantaged wrapper, this could be a game changer. But the rules are strict, the setup's complex, and the ATO doesn't mess around. So strap in. We're covering everything from the basics to the latest 2026 lender realities. First up, can your SMSF even buy property? Yes, 100%. SMSFs can invest in residential or commercial investment property as long as it ticks every compliance box. The big one, it must be purely for retirement benefits. No personal use, no holiday homes, no renting to yourself or relatives. That's the sole purpose test in action. For residential property, you cannot buy it from yourself, a relative, or any related party, even at full market value. No living in it, no leasing it to members or related parties. It has to be rented to unrelated tenants on commercial arm's length terms. Commercial property is a bit more flexible. You can buy from or lease to related parties if it's business real property, and everything's at market rates. Now, the star of the show, borrowing to buy. SMSFs can't just rock up to a bank for a standard home loan. Borrowing is only allowed through a limited recourse borrowing arrangement, or LRBA. Here's how it works. Your SMSF sets up a separate bare trust, also called a holding trust or custodian trust. That trust buys the property and holds legal title. Your SMSF is the beneficiary and provides most of the purchase price plus the loan funds. The lender's security is limited to that one property. If things go south, they can't touch the rest of your super. That's the limited recourse bit protecting your other assets. Key LRBA rules in 2026. The asset must be a single acquirable asset, usually one property title or a collection of identical assets like shares. Loan terms must be commercial and arm's length, especially if it's a related party loan. The ATO publishes safe harbour interest rates each year to avoid non-arm's length income, NALI, headaches. For 2025-26, real property safe harbour is around 8.95%. Down a touch from previous years. Check the ATO site for the exact current figure. Lenders often require a cash buffer in the fund. Think 10% of the property value in liquid assets post-settlement for servicing comfort. What about the loan numbers? LVRs, loan-to-value ratios, vary by lender and property type. In 2026, residential investment properties up to 80% LVR from some specialist lenders, though many sit at 70%. Commercial, often 70 to 75%. Deposits, expect 20 to 30% plus from your SMSF cash, plus stamp duty, legals, and setup costs. Rates, typically higher than standard investor loans, starting from around 6.5 to 7% variable in recent offerings, but shop around. Terms, up to 30 years, with interest-only options for the first 5 years common. Lenders treat SMSF loans as more commercial, so expect extra scrutiny, stronger financials in the fund, proof of rental income covering repayments, and often personal guarantees from members. Pros of going this route. Rental income and capital growth taxed at concessional super rates, 15% max or 0% in pension phase. Leverage inside super, grow your retirement nest egg faster. Asset protection, limited recourse shields, other super assets. But watch the risks. Property is illiquid, tough to sell quickly if needed. Interest rate rises can squeeze cash flow. Compliance breaches can trigger massive penalties or even lose your fund's complying status. Setup costs, legal fees for the bare trust, valuations, audits, it adds up. Quick 2026 updates to keep on radar. Lending criteria have tightened in spots, but specialist non-bank lenders are offering better LVRs, up to 80% than a few years back. No outright ban on SMSF borrowing, despite past chatter, but the ATO's eyes are firmly on NALI, sole purpose and arm's length dealings. Plus, payday super changes rolling in could impact contribution flows if you're topping up the fund. Bottom line, legends. SMSF property loans can supercharge your retirement if done right, but it's not DIY territory. Get your accountant, financial advisor, SMSF specialist lawyer, and a good broker in the room early. If you're thinking about this move, drop a comment below. Residential or commercial? What's your biggest question? Hit that like if this helped, subscribe for more weekly breakouts, and turn on notifications so you never miss an update. Until next time, stay sharp, invest smart, and keep breaking out. Mick Vitar signing off. Catch ya.